presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for May 21st, 2021. I'm Moe Ansari, President of Compak Asset Management and the Chief Investment Officer and host of Market Wrap. You tune in every day for the 1-hour update that I do across the country, and you can simply download the app and get the update every day by clicking on the link below. And don't forget to subscribe. Just click on the 3 buttons there, like, subscribe, and the bell button. That'll tell you every time that I post an update, you will get notification that we've posted an update. Please don't forget to do that. The more people do that, the more updates we can do. Don't forget also on the 9th of June, 2021, next month, I'm going to do a webinar. Haven't done that in quite a few weeks, so I'll give you an update, what is going on in the global economy. We'll look at the valuations, we'll look at the global economic picture, where we are, where we're headed, and then obviously in technicals. There'll be hundreds of you that are on that webinar, so I will try and answer as many of your questions as I can. So make sure you register for it. You have to be registered to access it. It's absolutely free. Click on the link below to register right now, and we will send you the access code for that. Let's start with the markets. Let's start with the recovery update, what's going on there. We'll talk about the U.S. markets. Then obviously my favorite, the language of the markets, technical analysis. We'll take a look at that also. With the recovery, 62% of the people in Israel have been vaccinated, 54.5% in the UK, and we're not far behind. It's 47.6% who have at least got one shot of the vaccine. So, and that gives you 80% efficacy against the virus. We're starting to open up. Even here in California, as of the June 15th, all restrictions will be removed, and that is going to be good news. Also, one interesting thing, a lot of people are asking, how long will this vaccine last? And now they're doing some tests and found out that SARS-2, which broke out in SARS, which was in 2003, people 17 years of age still have antibodies for that. So how long will the antibodies last? We don't know, but I think they will last longer. And if we do need a booster shot, like we do need for the flu every year, we'll get one, and that won't be a big problem. Let's look at the U.S. economy. It is reopening. We're looking at jobless claims for 473 in May, and that's where we are now. They were even lower this Thursday, yesterday, when the numbers came out. It's showing that the number of people applying for for unemployment claims is dropping. It was the lowest number we've seen since COVID. So we're going there. We're looking at TSA. It was 1.6 million on the 17th. This Sunday, we hit a record. We were at 1.8 million, which was one of the highest numbers we've seen, again, since COVID. So it is getting better and better and better. We're all starting to travel. The leisure travel has really come up. The business travel is not quite there. That's where the airlines make all of their money, is from the business travelers, but I'm sure it will gradually come back. They think it'll take longer. But finally, people, as we're getting vaccinated, we're all starting to, the pent-up demand there, the vacations we haven't taken in the last year and a quarter, so we're starting to do that. We're also looking at steel production, very close to where it was pre-COVID. So we're looking pretty good. We're reopening, and that reopening continues to gain strength. But with the reopening comes inflation. And as I had said in February that we're going to run up, my target was 42.35 that I said in February that we should get there by the beginning of May, by the end of April. We did. We hit 42.38. We backed off from there for the S&P 500. And then I said we are going to get into the summer doldrums. That's where we are. Everybody will start running around saying, oh my God, inflation is coming, inflation is coming. And if inflation comes, the Fed will have to raise interest rates. And if the Fed raises interest rates, that's going to kill the economy. That's going to kill the stock market. There's always something that the market has to worry about. We are going through what I call the shakeout and the wipeout in the markets. People who are the nervous nillies are getting shaken out of the market. And then the people who've got way too much in their portfolios are getting wiped out of the market. because they have too much exposure. They got all Bitcoin. It was 64,000. They were happy. It went down to 30,000. I'm going, what happened to my money? Well, that's gambling, not investing. I'm not saying you shouldn't have crypto, but the right amount, 1 or 2% maybe for speculation, that's fine. But buying good stocks, good companies at good prices, and staying with them for a period of time. But inflation numbers did come out. They went straight up. It is expected. I was expecting this. I said inflation is going to come out hotter than expected. It did. But I think this is more of a pig in the python sort of story, where we've seen the spike up right here in inflation numbers. We're comparing inflation now to the inflation last year. And as we were in March and April and May of last year, the economy was dead. So it's this bulge of inflation we're seeing, and we're seeing this reopening euphoria, as I call it. Once that dies down, I think we are going to see the economy fall back. And now we're also getting some numbers where the economic recovery is not going as fast as everybody thinks. So people are saying, well, if inflation jumps above 5%, that will cause the Fed to move. We will have to see. Inflation was running about 2.5%, 3%. So short term, we might see this bulge, and then we come back. And that's what the Fed has said, that this inflation bulge, this run up in inflation right here that we're seeing is transitory. That's the word that they're using, and no one knows if it is. If it is not, then the Fed will have to raise interest rates, catch up with inflation, trying to tap down inflation. But as they raise interest rates, payments go up for cars, homes, whatever people are trying to buy, and that slows down the economy. I talked about this last year. I think the Fed is not going to raise interest rates. They've repeatedly said that they're going to keep the very loose monetary policy. But I think the government is going to try and slow down the economy by fiscal policy, by raising taxes. And that is the big question. And that's where the market is right now. We are going back and forth. Market was down about 0.5% for the S&P this week. Nothing very dramatic, but we're going through this digestion period where we've seen the market run up, and now we're going to see it sort of find out how much inflation we're going to get, what will be the Fed reaction, and how much more stimulus we're going to get from the government. Mr. Biden wants $4 trillion more stimulus. I don't think he'll get it. If he gets 50% or 25%, somewhere around $1 to $2 trillion, he might get more for infrastructure spend and the other program that he's looking for. Raising taxes, some of the more moderate Democratic senators, which he needs every single one of them, especially Sienna and Kelly in Arizona and Manchin in West Virginia, have said, no, we don't want too many taxes, and they've already said no. He might get a corporate tax increase from 21 to 25. That will, I don't think, have any big bearing. But the big things he's talking about is capital gains tax and taking away the stepped-up basis. That could be big. If you don't know what that is, give us a call. We'll be more than happy to explain that to you. Looking at the numbers around the country, there's still a lot of businesses, especially in the San Francisco area. Only 48% are still, 44 to 48% are still closed. Around the country, we're still seeing somewhere around 30% are still closed. But I think in the next couple of weeks, we're going to see a lot of them coming back online. GDP took a hit. We are down about 4.5%, and GDP, that was the drag on the S&P. India, what we're seeing also, COVID, in the U.S., we're doing well with the vaccinations. Europe bungled the vaccination process. They're 2 or 3 months behind, but they are catching up because they have the vaccines. But then we're looking at India, which is in a terrible situation. We just saw Singapore will close the schools. We're looking at Japan, which has got they declared a state of emergency in 3 prefectures. So Asia is having a problem with COVID. But when you look at the numbers, it's 900 people got infected. We're still not in the thousands upon thousands upon thousands of people that were getting infected on a daily basis. And when you have hundreds of thousands of people that get infected, which is like in India, which hit a high of 400,000, now it's dropped to about 250, that's still a lot of people that are out there. Looking at the technicals, I think the market is in this sideways stage. That's what we've seen since we are going here and here, which is about, we came down to the 50-day moving average. We came and tested it a couple of times right here and right here. We tested it a couple of times. We've tested this area, which is around 40.50 to 40.60. Now the 50-day moving average has moved up to 40.90. If we break below the 50-day, then I think we can come down to about somewhere around here, which was the high that we made in March, which is about 4,000 for the S&P. A break below that puts it somewhere around 3,900. So these are support areas. We have a tiny gap. We filled that today at 41.88. Just got to the bottom of this right here. If we can get above this, we can get above this right here, that would be good. Looking at the weekly charts, again, came down. We're testing the 20-week moving average, and that's where it is, support around 40.56, and then we have 39.28 and 3,800. On these, each one of these little one line is 1 week of trading going back to about 2017. As you can see, this was the drop last year, and we're still in the third wave. Everything moves in 5 waves. We got to third wave, fourth wave down, fifth wave up, and that's where we saw the top last February, and then we saw the decline. Now we're still in a third wave. We've seen wave 1, wave 2, wave 3. Somewhere we are going to get wave 4 down, and then we get on the fifth wave to the upside. Are we going to get that fourth wave down now in the summer, or are we going to get that later on next year? We don't know, and that's the market is trying to really parse through all of the different crosswinds that we have in the market until we get a clear picture on inflation and consequently what the Fed is going to do and how much stimulus we're going to get from the government. I think the market is in the summer doldrums. As I said in February, we hit the 42.20-35 area, got to 42.38 as a high. Now we're in the summer doldrums. Couple of months of sideways movement, digesting this huge run-up that we've seen in the market, and then we decide, depending on what the economic data looks like, we're going to move from there. The Nasdaq, on the other hand, also made a fifth wave top on the daily charts. We've gone through this 1, 2, 3, but it is still below the 50-day moving average. The 50-day is 578, 13,578. We closed at 13,470 today. So we came and touched it again, this blue line, and as you can see right there, came and touched it today and fell back down from there. We need more work to do. It's like a runner that has run really fast, then it slows down a little bit to catch its breath, and that's what the market is doing at this time. On the weekly charts, one thing I did not like is the market coming down, hitting these little dots right here, which usually gives us 2 to 3 weeks of sideways movement. So that's what we've seen, and we might see a little bit more of this sideways back and forth in the Nasdaq, and we have to get the Nasdaq going for the rest of the market. Looking at gold, it had a great week. It got above the 200-day moving average, which is around 1850, and stayed above it. Came back and tested it, stayed above it, closed above it, and closed at 1881. Next resistance are these highs that we made last year in January and then last year in November, which is around 1960. That seems to be the target on the upside. As long as we hold 1850, then we have more support about 1800, and then more support around 1775, and obviously this double bottom at 1650 or so is where this double bottom comes in. That's the gold market. Gold benefit from some of the volatility we've seen in the cryptocurrencies. Everybody's saying, look, we're buying crypto. That's the safe place to be. It went from 65,000 down to 30,000 intraday. It's at about 36,000 on the close now. So it has come way down, especially with, as I've said, one of the biggest problems with crypto is government regulation. China came out last night and said, no, they're very concerned about it. It has to be controlled. And we might see some more control here in the U.S. The IRS's Treasury is starting to talk about how anybody trading more than $10,000 in crypto has to be reported to the IRS. So I think we are going to get, and that is the biggest threat to crypto, is the regulatory risk. On the emerging markets, again, sideways movement, not going anywhere, stuck between right here, between the 200-day moving average and the 50-day, which is 53.71. We closed at 53.14 today. That's just sideways until we get the vaccines out in the emerging markets. The small cap also stuck between 2100, which is resistance, and about 2350. Just for the last 3-4 months, we've just gone back and forth and back and forth and back and forth. Resistance is around 2240. We closed at 2215. 2240 is the 50-day moving average, and we have great support around 1900, but 2100 has been good support for the Russell Small Cap Index. Looking at the weekly chart, again, we in the third wave, we made a third. We might get this qualify as a fourth wave pullback. Once we get the fourth wave done, we can start on the fifth wave to the upside, and that gives me initial target of 24.25. That's the way I'm looking at these markets this week. Not a lot going on, just a lot of volatility, the shakeout and the wipeout. Just as long as you have the correct allocation, you have the correct shock absorbers built into your portfolio where you can handle the volatility. Right now is not a time to make big changes, but stay where you are with the right allocation. To find out the right allocation, you can simply come to our website at compak.com and click on the button Get Started. We'll do a free review of your portfolio. We will also give you your risk number, which is the speed limit at which you should be going. That's your emotional risk and your financial risk we combine and give you a speed number. It might be 62, it might be 57. What does that mean? We give you then a corresponding portfolio. And as long as you're comfortable with that, that gives us the correct risk number. If you have too much risk, the markets go through what they've gone through right now, you lose 30, 40, 50%. That's when you have a problem with the market. So that's why having the right allocation is the way to do. I'll talk about this a lot more at the next webinar, which is going to be June 9th. If you'd like to register on it, just click on the link below and you'll get a free registration to the webinar. It's going to be at 6 p.m. Pacific time on the 9th. I hope you have a great week. I'm Moe Ansari. I will be back next week to do the next update. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.